Is the South African Football Association fan token a hidden gold mine disguised as a failing asset, or are investors rushing toward a financial cliff? Right now, the SAFA token is trading at approximately $0.3071, posting a sharp, eye-catching 13.61% gain over the last 24 hours. But don't let that sudden green daily candle fool you into thinking it's all smooth sailing ahead. If you zoom out even slightly on the macro charts, the overarching trend tells a radically different story, one dominated by lower highs, breaking support levels, and technical sell signals that have triggered massive warning lights across institutional dashboards. Despite this bleeding macroscopic trend, a highly passionate group of sports investors and deep value traders are aggressively insisting that this token is drastically undervalued at 30 cents. They argue that the market is completely mispricing the underlying utility and cultural power of national football fandom. Are these buyers brilliant contrarians getting in at a historic bottom, or are they blindly walking into a classic, beautifully wrapped value trap? Let's dismantle the data piece by piece to find out exactly what is going on behind the scenes. To understand why the South African Football Association fan token is suddenly dominating trading volumes and social media feeds today, you have to understand what this project actually represents. Unlike typical meme coins or abstract decentralized finance protocols, SAFA is built entirely around real-world utility, sports engagement, and fan monetization. The token operates as a digital pass that grants holders exclusive voting rights on minor association decisions, priority access to national team merchandise, VIP match day experiences, and unique digital collectibles tied to South African football history. It bridges the massive multi-billion-dollar world of international sports with Web3 infrastructure. It is in sharp focus right now because fan tokens globally are experiencing a massive wave of volatility due to shifting tournament schedules and major upcoming international fixtures. When national teams gear up for high-stakes matches, speculative traders and genuine football fans collide in the market, creating massive liquidity spikes. But the underlying issue plaguing the token right now is a severe mismatch between short-term speculative hype and sustainable long-term tokenomics. Before we tear into the technical chart patterns and structural weaknesses, I need you to do me a massive favor. Smash that like button, subscribe to the channel right now, and leave a comment below with your exact strategy. Are you holding your SAFA tokens, cutting your losses, or doubling down on this 30-cent level? Leave a comment right now because your engagement directly drives the algorithm and keeps these independent breakdowns alive. Let's pull up the charts and jump straight into the technical analysis, because while sentiment can lie, order books and price action never do. When you look at the daily and weekly time frames, the SAFA token has been locked in a grinding, multi-month descending channel. Every single attempt by the bulls to break out of this pattern has been violently rejected at the 50-day moving average, which is currently acting as a dynamic, heavy iron ceiling. The recent 13.61% daily pump has brought the price right up to a critical resistance level near 31 cents. If the buying volume completely dries up here, this minor bounce will be remembered as nothing more than a textbook dead cat bounce. Looking closely at the momentum indicators, the Relative Strength Index, or RSI, has quickly pivoted from near oversold territory up to the mid-ranges. This indicates a sudden influx of short-term buying pressure, but it lacks the sustained volume profile needed to confirm a structural trend reversal. The support floor at 30 cents is the line in the sand for this asset. If that level breaks on a daily closing basis, there is a severe lack of historical order block support beneath it, meaning the price could easily enter a free-fall phase to search for a new macro bottom. Short-term strength looks highly deceptive, while long-term structural weakness dominates the entire chart. When we shift our attention to analyst ratings and smart money signals, the broader outlook darkens significantly. On-chain data and blockchain analytics platforms are currently flagging the SAFA token with a strong sell or heavy hold rating. The negative signals are piling up rapidly behind the scenes, specifically regarding wallet concentration and large whale movements. Over the last 30 days, blockchain trackers show that several early seed investors and large wallet whales have been systematically distributing their holdings into the retail market, taking advantage of short-term hype spikes to exit their positions. When the largest holders of an asset are quietly trimming their exposure, it creates an incredibly heavy overhead supply that makes a sustainable bull run nearly impossible. Furthermore, Institutional sentiment indicators remain firmly bearish, noting that the token's trading volume is heavily fragmented across a small handful of secondary exchanges, which naturally heightens the risk of sudden, erratic price manipulation. The short-term outlook suggests that unless the association drops a massive, unprecedented fundamental announcement, the path of least resistance for the SAFA token remains heavily weighted to the downside. This reality brings us to the ultimate polarizing debate. Is the South African Football Association fan token deeply undervalued, or is it a dangerous value trap designed to wipe out retail capital? The bullish faction argues that at 30 cents, the asset is trading at an absolute fraction of its true fundamental worth. They believe that as global sports adoption scales and Web3 applications become mainstream among sports fans, a token backed by an entire National Football Association possesses an indestructible floor and massive asymmetrical upside potential. To them, this is a prime accumulation zone. The bear camp, however, views this logic as a complete delusion. A value trap occurs when an asset appears incredibly cheap on paper, simply because its fundamental token mechanics are actively deteriorating. If a fan token cannot maintain consistent daily utility that requires people to actively buy and hold the coin, rather than just using it as a short-term trading vehicle, the price will naturally drift lower over time, regardless of how prestigious the underlying sports brand is. A low nominal price does not automatically make an asset a bargain. It can simply mean it is on a slow, painful march toward irrelevance. The downside risks embedded in microcap utility assets like the SAFA token are absolutely immense, and retail traders get brutally trapped in these exact setups every single day. The primary reason retail investors suffer catastrophic losses here is a psychological bias toward low-priced coins. Traders look at a 30-cent token and think, if this just returns to its previous high of a few dollars, I will easily make 10 times my money. What they completely fail to realize is that market structure, circulating supply inflation, and order book depth entirely dictate price direction. Fan tokens are notorious for extreme violent volatility because they have highly illiquid order books. When panic hits the market, liquidity vanishes instantly. This creates a nightmare scenario known as massive slippage, where you might see a specific price displayed on your portfolio screen, but when you actually try to hit the sell button, there are zero buyers at that level, forcing you to liquidate your tokens at a devastating loss. Let's clearly map out the absolute best case bull scenario versus the worst case bear continuation. In the absolute best case recovery scenario, the South African Football Association secures a massive multi-million-dollar global sponsorship deal that integrates the SAFA token directly into stadium ticket sales, international broadcasting packages, and mainstream fan rewards. This massive fundamental shift would force short sellers to rapidly cover their positions, triggering a violent short squeeze that could easily catapult the price back toward major psychological resistance levels at 50 and 70 cents. On the flip side, the worst-case continuation scenario is backed by far more historical data. If the immediate support at 30 cents fails to hold during the next broader crypto market correction, stop-loss orders will cascade simultaneously. The panic selling could easily trigger a brutal 50% to 70% capitulation event within a matter of hours, leaving late-stage retail buyers holding an incredibly illiquid bag. Looking at the overarching outlook, we are witnessing two completely different timelines play out. In the immediate short-term perspective, the macro trend is undeniably your friend, and right now that trend is pointing straight down. Expect continued chop, deceptive fake-out pumps, and intense volatility as the market tests the psychological limits of current holders. From a long-term perspective, the project's survival depends entirely on transforming the token from a speculative digital collectible into an absolute necessity for millions of sports fans. Without a radical structural overhaul in how token utility is maintained and a burn mechanism to offset circulating supply, the long-term chart will inevitably continue to mirror the short-term macro decline. So, where does that leave us at the end of the day? Is the South African Football Association fan token a ticking time bomb waiting to liquidate the remaining retail community? Or is this 30-cent level the definitive historic bottom before an explosive multi-X reversal that catches the entire market off guard? The numbers are at a total unforgiving crossroads. And the next major breakout or breakdown is going to catch thousands of undisciplined traders completely unprepared. Which side of the order book will you be standing on when the real move begins?